Good morning. Welcome to Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Reema Tendulkar, and with me is Vinny Motiwala. And after 7 good days on the trot where the markets were running higher and higher, today is a session of consolidation. Markets have paused. The Nifty is down 50 points, just shy of the 24,300 mark. The Sensex has slipped 180 points. Mid-caps, though, continue with their relative outperformance. So no gain on the mid-cap index. The mid-cap index is flat. But this week, the mid-cap index has clocked in a gain of 4.5%, significantly outperforming the Nifty, which is a gain of close to about 1.5%. On to the top, gainers. Reliance Industries is a tad bit subdued ahead of its, numbers tomorrow. So keep your eye on that. Hi.
Hi, Reema. Good morning. So like you were mentioning as well, a bit of a subduedness is what we're seeing in terms of the market after 7 consecutive trading sessions that decline. Volatility is obviously something that is there today because there's expiry as well. But, a sector that is doing well in this grim is pharma. Look at the Nifty Pharma. We've seen a bit of a spike coming in the last half an hour specifically as well. A lot of announcements today that have come in specially for these pharma names. So that is something that we'll be keeping an eye out on. We'll deep dive into all those names separately as well, whether DVs, Thyrocare, GSK Pharma, Syngene, Lupin, all these names are something that have been buzzing in trade today. And specific reasons for that we'll get you all through in the later on part of the show. But FMCG, let's just focus on that because today we had HUL that had reported its numbers sometime back. Now, post that we're seeing HUL is in focus, Nifty, FMCGs, that's seen a bit of a furthermore decline coming in as well. FMCG is reacting to Tata consumer numbers. We'll have Nestle that is reporting its numbers today as well. Now, specifically on HUL, today as of now, the stock is down 3%. Overall, numbers seem like largely inline set of numbers in Q4 FY25. Volume growth is coming in at 2%. But to break down and analyze these numbers, Mangalam is here to give us more details on that front.
Well, Hindustan Unilever recorded an in-line performance in the fourth quarter, where the revenue grew by about 2.4%, the EBITDA grew by about 1%, largely in line with very muted expectations of the street. But what was positive were a couple of things. One, the company scaled back on some ad spends to ensure that the margins are, improving. Between 22 to 23% is the guidance that the company is given going forward as well. This, despite the volatility that we've seen in raw material prices. And secondly, the underlying volume growth this time around has come in at 2%. Most on the street were working with a number anywhere between 0 to 1%. So to that extent, there has been a positive performance that has come in. Add to that, the stock is at near 5-year average valuations itself after having underperformed. So the street believes that maybe going forward, there could be sort of an inflection point and improvement in the demand environment for the company itself. And that's exactly what the management has said as well. If you look at beauty and well-being, that grew by about 3%. Personal care grew by 3% as well. And home care delivered a 3% underlying volume growth. The company said that going forward, they expect demand conditions to gradually improve over the next fiscal year, for which they are committed to unlock growth for the company itself. So largely in line with muted expectations, a few bright spots and attractive valuations versus its 5-year average has the stock excited in today's trading session.
Okay, Mangalam, thank you so much for that. And we'll also go across to the management of HUL addressing the media after the Q4 earnings. Okay, let's move on and shift focus and talk about one of these pharma names that have been in focus today. Lupin, that's seeing a spike up in today's trading session. Why? Because yesterday we had spoken about this, right? The company was expecting to get an approval coming in from the US FDA. This was for the generic version of the drug of tolvaptan. That's the drug that we're talking about. Now, obviously, the patent expiry has happened of this drug for the innovator. So that is why they've gotten this approval. Now, for Lupin, they will be the first to file of this product. They've signed in the press release, they've mentioned in the press release as well that there will be a 180-day exclusivity that they'll have on this generic drug as well. Other than that, they will be launching this product soon. They've not mentioned an exact launch date, but soon is what they've highlighted. Manufacturing this product in the Nagpur facility. Analysts, what they are highlighting, they expect this generic drug to have an opportunity for Lupin almost in the $150 million to $200 million range for FY26. And possibly this could contribute to 25% plus for Lupin in terms of FY26 earnings. Axis Capital also has said that they have revised the FY26 EBITDA and profit outlook for the company, factoring an 8 to 10% increase furthermore from what their previous estimates were. So that is something interesting. A big drug coming in for Lupin with 180-day exclusivity is something that's keeping a stock abuzz as well, Reema, today.
Okay, but Syngene, that's the big casualty of the day, and there is some guidance cut as in what the company is guiding for is lower than what the analysts hope to hear.
Absolutely, Syngene, the numbers were in line when you look at it. Nothing bad that came in terms of numbers. But for FY26, the guidance in terms of revenue, it's lower than what the street was expecting. Base business, yes, mid-teens is the guidance given, but for overall business, single-digit revenue growth is what they're talking about. Other than that, do not forget, FY25 was already a subdued quarter for the company. So if, apart from that, you're seeing more of a subduedness even in FY26, then that's something that's fearing the street. But other than that, they're expecting the EBITDA and the margin front also to be a bit subdued. Profits also to see a decline on a year-on-year basis in FY26. So that is some bit of a worry that's coming in for Syngene in terms of their numbers. Going forward, that is something that we'll be keeping an eye out on as well. But commentary seems to be a bit weak in terms of the guidance for FY26, and that is why today we're seeing Syngene that's down and out in today's trading session. But on the flip side, we have DVs, that's buzzing in trade as well today. The company has actually, gotten, this is a note that's coming from Citi. Now, they are maintaining a buy rating. Target price is up to 7,050 rupees from 6,850 rupees. And this is mainly, they believe that, DVs could be one of those players who will benefit from Eli Lilly's oral drug that is going to be launched or that's going to be coming up. They would be one of the primary suppliers. So because of that, they believe that this is a very big positive that could come in for DVs.
Welcome back. Let's turn our attention now to the commodity markets. Manisha, as promised, is now with us on the show. Manisha, what is the commodity that you're looking at today?
Well, I'm looking at the gold prices because the volatile moves in this space just about continue. After hitting an all-time high in this week itself at around $3,500 an ounce, we've seen some profit-taking come into the markets. Well, yesterday it fell all the way down to below 3,300, but it's holding above those levels at this point in time. And there is a volatility of anywhere between $60 to $100 an ounce that we are seeing in gold prices on an everyday basis. Not just international gold prices, but the Indian prices, after hitting almost a 99,400 level of a mark, have seen some decline coming in, holding around that 96,000 rupees at this point in time. But even with these corrections, if you look at the gold prices, they're up by 10% on month and up by 27% in this year until now. Well, the markets are looking at a few things which have led to some decline or some cap in the gains coming in. One is the dollar index, which did fall below 99 toward 3-year lows. That has seen some gains come in. And then there's a bit of a uptick in the global equity markets as well. So you have seen some gold money go in there as well. Markets also are looking at US indicating potential lower trade tariffs with China. There has been some retracting of statements as well about the US Fed independence. And that also has eased a bit of a safe haven buying that we saw in gold. But a couple of important developments, and that would continue to support gold prices. One is China buying gold. The central bank and the institutions have been, even the insurance companies are buying quite a bit of a gold. And March has been a 5th straight month of gold buying there. If you look at the numbers therein, well, China bought 50 tons in Feb and another 5 tons in the month of March as well. China has been buying for the last 3 years now, and that pattern just about continues even now. More interestingly, even as China is talking about internationalization of yuan, China also is looking to invest via Shanghai Gold Exchange in sense of gold. There are conversations and reports that gold trading in China could also be internationalized, and not just trading, but deliveries and warehouses also will be opened up to the world. That really comes in on a big one, and that has been supportive for gold. Well, that's about China. But when you look at the US imports of physical gold, they also have been on the higher side. They're actually categorized as industrial supplies and materials. So when you look at the US trade data, that shows you that in the month of November or for the month of Jan, we have seen very strong gold being bought into US. In November 2024, the holdings or imports per month was at around $2.8 billion, which we have seen surge in the month of Jan. This was ahead of tariffs. In the month of Feb as well, it has been a double-digit $1 billion of an import in US that we have seen come in for gold. Another important thing to watch is the statement that has come in from the Atlanta Fed official Mitchell, who says that they're looking to introduce new GDP estimation model adjusted for gold trade. So there are newer developments coming in from across world, especially from China and US when it comes to gold trade, and that clearly would be supportive going forward. Global ETF holdings for gold also are at September 2023 highs, and the gold ETFs for US are at all-time highs. So various newer records being created there as well. So even as we are working with a bit of a profit taking in case of gold, Goldman Sachs, JP Morgan do tell us that it would be higher highs, all-time highs before we close this year. And then they are estimating $4,000 an ounce for 2026 as well. So, well, buy on dips does look like a strategy.
Absolutely. Buy on dips does look like a strategy. Right now, some profit booking, but going forward, maybe year-end, we could see newer highs coming in as well. But on that note, we're going to slip into a very short break. When we return, we'll discuss market technicals with Vishal Mankan of mulkansview.com and also discuss their top trading bets. Sudarshan, thank you so much for that. But let's cut across to my colleague Mangalam and Shilpa, who are in conversation with Rohit Java, CEO and Managing Director of HUL.
During the year, we continued on our journey of sharply executing the Aspire strategy to unlock a billion aspirations. We have segmented our portfolio into core, future core, and market makers. Our segmented portfolio approach facilitates better allocation of resources to maximize overall organizational growth. In financial year 25, we continue to modernize our core portfolio with relaunch of Lifebuoy and Glow & Lovely, strengthened our market position in future core, and delivered double-digit growth in market makers portfolio. Our focus on transforming our business into high-growth spaces has led to a 200 bps shift from core to future core and market makers. We have accelerated our pace of transformation with sharper where-to-play choices. We acquired a majority stake in Oziva, a health and well-being business, in January 23. The business has since scaled up from an annual run rate of 100 crores to 400 crores. Last quarter, we announced the acquisition of 90.5% stake in Minimalist. I am pleased to inform you that we have completed the closing formalities as of 21st of April 25. We look forward to unlock the next phase of growth with Minimalist, which is now a part of larger HUL ecosystem. Period business divestment was completed, unlocking value of circa 600 crores. The demerger of ice cream business is progressing on track with regulatory requirements, and we expect it to be completed by end of financial year 26. In line with our strategy to strengthen business resilience, we announced the acquisition of palm undertaking from Vishwatej Oil Private Industries and announced our investment in Lucro Plastic E-Cycle Private Limited. The former will aid our palm localization strategy, while the latter is a step towards developing flexible plastics circularity. Considering our performance for the year, the Board of Directors have proposed a final dividend of Rs 24 per share, subject to approvals of shareholders at the AGM. Together with interim dividend of Rs 19 per share and special dividend of Rs 10 per share that we announced in October 24, the total dividend payout for this year will be 12,453 crores. Moving on to March quarter 25 results. Underlying sales growth was 3% and with an underlying volume growth of 2%. Gross margin at 49.8% was lower by 160 bps year-on-year. This contraction in gross margin was driven by commodity inflation across palm oil, tea and coffee that wasn't fully priced for. EBITDA margin remained healthy at 23.1%, lower by 30 bps year-on-year. Profit after tax before exceptional items and profit after tax both grew at 4%, including the benefit of interest income on prior period tax adjustment. Coming to performance across the four business segments, Home Care delivered a robust mid-single-digit UVG, which translated to 3% USG as we continue to pass on the benefits of deflationary commodity prices to our consumers. Beauty and Wellbeing grew at 3% USG, led by volume. While Hair Care delivered double-digit growth, Skincare was impacted by mass skin performance. Personal Care delivered 3% price-led growth, while UVG declined in low single-digit. Skin cleansing led by non-hygiene segment continued its positive growth momentum. Oral Care delivered price-led growth. Foods turnover declined by 1% on the back of mid-single-digit decline in volume. Robust performance in beverage, ice cream and packaged food was impacted by performance in nutrition drinks. Margins in all four segments remain healthy, with Home Care at 18%, Beauty and Wellbeing at 33%, Personal Care at 18% and Foods at 16%. Moving to our near to mid-term outlook, we expect growth to gradually improve as a result of our accelerated portfolio transformation actions and improving underlying macro conditions. We anticipate first half of financial year 26 to be better than second half of financial year 25. If commodities remain where they are, we expect price growth to be in low single digit. Gross margin is expected to further moderate due to commodity inflation and our continued commitment to provide consumers with the right price-value equation. We will step up investments behind our multi-year market-making platforms, channels of the future, and strategic capabilities to successfully land our portfolio transformation. As a result, EBITDA margin will be maintained in the range of 22 to 23%. We believe this is the right time to accelerate investments as we chart the future course of growth for the company in the backdrop of portfolio transformation actions and improving macro environment. With this, we conclude our prepared remarks, and I will take questions.
Hi, thank you so much for speaking. If I could just quickly touch upon the urban demand scenario, can you give us a little more clarity on how the improvement's been there? Are you seeing any rebound in the urban growth and also a little bit of the rural demand also? Give us a little more sense on the inflationary scenario also. You said low single-digit price growth is what you're expecting. Going forward also then, how do you see the volume to price mix also changing for the fiscal that we're entering into? And then on the same lines, then how do we look at the margin profile as well?
So maybe I can cover off the broad market shapes and then Ritesh can talk through some of the more nuanced points you asked about the price and mix. So broadly speaking, we've seen market growth subduing over the last few quarters, largely led by urban. Rural, on the other hand, is resilient and robust, and we see that holding up. And we do expect going forwards, macro triggers are positive. We see, of course, the food inflation coming down sharply. We see the interest rates also being reduced. That will impact the EMIs and therefore lots of urban households. The crude oil being softer also does impact the entire economy. The agricultural output is strong. The monsoons have been good after a long period of difficult weather conditions. The reservoirs are full, the granaries are full. We believe that the rural areas would remain robust. We as a company, of course, have or will compete in all market conditions, but we do expect that the macro drivers are positive going forwards, and we expect the urban demand therefore to start, inching back up. Therefore, on the whole, we do see gradual improvement in the macro. Importantly, for our own business, we are very committed. We have been, going where the growth is, despite what the market conditions were in the last few years, and we've been strengthening our portfolio, moving it to faster growth spaces, getting channels of the future, building capabilities, innovating quite intensely, acquiring brands, launching brands. So we feel quite confident at this point that we have a strong investable portfolio. We are operationally quite robust. Our brand powers are strong, getting stronger. Our penetration growths are good. So we expect that as tailwinds come in, we are best prepared for this turn. And therefore, we feel confident at this point to lean in and invest for the future. There'd be categories that are price sensitive, where there's high level of competitive intensity. We are going to unblinkingly defend those categories. We're also going to make sure that our price value equation is absolutely on dot. That gives us the best chance to actually improve our competitiveness further. So we are being quite active and I would say leaning in aggressively on investing on our business. We believe this is the good time to do that, and it's a very opportune time to invest for the future of the FMCG in this country, which, as you know, is a long game, is a great place to be in.
Right.
So let me just add and pick up the other questions you had. So as Rohit mentioned, both we look at external atmosphere of macro conditions and what we have done internally to drive our portfolio transformation. Put together, there's a pretty strong case for us to further dial up investments going forward. Coming to pricing, there are two different group of commodities. When I look at crude oil and related commodities, which impacts by and large home care, we are seeing deflationary scenario there. In fact, crude oil back to back for the last 2 years has been deflationary. But we see a group of commodities like palm oil and tea where we have seen inflation. And hence, there are reasons where certain categories will see price increase, certain categories we will have some price decrease. On a net basis, we expect low single-digit price range going forward. To your question, where do you see the balance between volume growth and price growth going forward? It's a healthy mix as we speak this point in time, but as the year will progress, if commodities remain where they are, volume growth will be ahead of price growth.
Right. But which are these categories, Ritesh, if you could say, where we can expect price decreases and where can we expect the price increases?
Yeah, so home care is the category which gets largely impacted because of the crude oil. This is where, as we speak, in the quarter, we had a negative price, and this is where the momentum of pricing will be negative, unless, again, the signals of commodities end up changing. And price increase will be essentially in skin cleansing, which is where crude palm oil has increased, and tea category. Of course, tea, I'm very mindful. We are now not in season for tea production. The new crop will come in May and June, and we'll have a different signal, if at all, and we'll determine basis that what happens later on in time.
Right. If you could also just touch upon the margins bit that I was talking about. How do we look at the margins?
So margins, the way what we had explained, that we are now investing behind more, given both the right time to invest because of internal dialing up of the portfolio and because of external improving conditions. Because of that increased investment, we will go to a little lower EBITDA range of 22 to 23%. This guidance is for next few quarters for us. Right. Now, of course, few quarters later, we'll determine into what guidance we end up operating at, looking into market conditions. As Rohit mentioned, we always maintain between growth and profit, it's unblinking growth as a priority for us. And we have very strong levers to manage margins. This is more investment-focused decision where the margins will be a little lower compared to where we are today. Our machinery, our reflex muscles on driving savings across all lines of the P&L, that remains very strongly installed. And it will keep helping us to keep driving more amount of investments across the board.
Just to confirm on that, last time the guidance was between 23 to 24% of margin. So right now the guidance is 22 to 23% and on the lower end of that band. Is that correct?
So let me clarify. Last time we had spoken about a guidance of 22 to 23, and we said we'll be the lower end of that range. So more towards 23 is what our last guidance was. Okay. Today, what we're speaking about, that we are lowering that number to a range of 22 to 23, because we believe now is the right time for us to dial up further investment to drive growth.
Okay. And in terms of one more thing, there's a trend that I observed yesterday in one of your peers that came out with the numbers. They said that they've seen more traction in the lower end of products, and of course the small packaging trend has always been there. But something that came out in their commentary was that there was more traction seen in lower end of products as compared to premium products. Is that something that you have also observed?
So, first of all, we speak from what we see in our own business, and I just restrict my commentary to that. We have seen premiumization, as I mentioned to you, and we must always keep our lens a bit wide. Zoom out, first of all, then zoom in. On zooming out, this is a market that premiumizes. In the long term, people are upgrading their quality of life, they want better products, and I'm not talking of, extremely privileged or luxury products, but people climb up to a better quality of product experience at every level. That trend is secular. We do see that trend continuing this quarter and last quarter, although it's compressed a little bit. So instead of premium going much faster, it's sort of come down a little bit, but it's still faster. So there is a general upgradation trend, although it's muted compared to the past few quarters. We must not make too much of it and stick focused on the long term, because eventually the market has upgraded, we upgrade. We are a very, very low per capita consumption market at this point.
Right.
So that's number one. On the pack sizing, the large packs still are growing a little bit ahead. There is a trend towards downsizing. People are probably managing their budgets. Of course, as rural is growing now in the last few quarters ahead of urban, and rural consumption generally tends to be on the low pack size. That also weighted average makes an impact. So there are these twists and turns, but I would not overly focus on them. I think the market in all categories is at a very low per capita consumption, and market development is the main thesis for growth. Innovation, improving quality of our products, getting people to use something more better is the main thesis of growth in this market, and we stick to that in medium and the short term.
Any guidance with respect to growth where minimalist is concerned, because beauty and personal care has done very well this quarter? What are the kind of targets that you are looking at right now?
See, we had mentioned as we acquired the business now, we completed the whole transaction 21st of April. We are very focused to unlock both growth synergies and cost synergies. Leveraging the R&D entire process and capability that we have as Hindustan Unilever, we will benefit the business of Minimalist with that. Our supply chain network of production capacities and our expertise in that space will end up giving synergies to Minimalist business. We will also aid international expansion of the business. And last but not least, Minimalist is by and large an online brand, and we'll end up leveraging the offline distribution. So these are the 4 elements of synergies with which we will now start running the business. We'll keep you updated in times to come how those synergies are going to look like. But we are very optimistic. It's a fabulous brand, very well positioned in the masstige skincare category, and we do believe now within the family of Hindustan Unilever, it will have a very bright future.
Welcome back to Trading Hour on CNBC-TV18. Now, let's get a check on the market on the technicals. And we have Vishal Badkan of Malkansview.com joining in with us to give us that check. Vishal, morning. Thank you so much for joining in with us. Today, what we're seeing in terms of the market, after 7 days, we're seeing the red on the screen for Nifty below the 24,300 mark. What are we technically watching out for? Could we see a further fall coming in, or what are you expecting today?
Yeah, hi. I think the rally which we had in the last 7-8 days is a very sharp one, like a perpendicular one. So there needs to be some breather, which the signs are already there in the last couple of days. So it can be like a consolidation before we move forward, like between the range of 23,900 and 24,300 could be a good range. So there could be a small correction, or what we can say retracement, where it comes down to 23,900 or 24,000 and then take support and then move forward. So there would be some subdued market for the next few sessions.
What about stocks? Vishal, what are you recommending? And any thoughts on HUL and the fall to 100-day moving average that we've seen?
Just checking out on HUL has, of course, has corrected due to results, and there's a big candle, like big volume. So there is definitely some kind of resistance on those levels, and it can further go down to 2270, 75. That could be a good support where HUL can take support. So for the timing, I would avoid, especially because it is news driven or event driven. So I'll avoid and wait for a dip till 2270 on HUL. And as far as stock specific is concerned, I think one stock which is looking strong as of now on my charts is CDSL, which has given a good breakout about that 1350 level. So we can go with a buy on that with a stop of 1335 for targets of 1420 and 1475 in the next few trading sessions.
Okay, Vishal, thank you so much for that, talking us about the levels and taking us through the levels for the market as well as in terms of stocks. HUL as well as CDSL is something Vishal has mentioned and spoken about liking as well. But let's move on, and Devang Mehta from Spark Private Wealth Management is joining in with us to discuss market fundamentals and his top sectoral bets as well. Devang, good morning. Thank you so much for joining in with us. In this current global market scenario that we're seeing, domestic market, we have earnings that are coming in as well. Where do you see growth coming in? Where are you bullish on now going forward?
Good morning, Vinny. Thanks for having me on the show. I think very clearly the growth pockets are right now clearly visible in the market. What has happened over the last few days, to be precise, from April 7th, where I think market formed a bottom, and from there on, a 10% rally in the large caps and almost the same amount of rally on even the mid cap and small cap indices have been actually showing the market's resilience. Why I say that? Because it's extremely fashionable to be in and out of the market, and there are a lot of questions about probably raising cash or staying underinvested. But I think this is where clearly one differentiates that when you stay invested, you probably don't miss the best days of the market. And if you miss the best days of the market, your return suffers drastically. Now, coming back to the question, very importantly is which are the sectors which are sort of participating. I think there was a lot of hue and cry around which sectors would probably lead the rally. And if I can say, this rally has probably started from the bottom or whatever the last few months of correction. A couple of sectors come to mind. I think very clearly one theme which we've been very bullish on, the entire capex, manufacturing, infrastructure, capital goods, manufacturing, sort of this type of theme where there can be data centers, where there can be power automation, there can be lamination, there can be engineering type of companies. And these companies had undergone a severe correction, not only on the price front, but also on the valuation side. But if you look at the order book of these companies, I think the last 1 quarter where numbers were not so great, but if you look at all this order book of these companies, they've been generally very robust. Secondly, the government activity which had slowed down in the October, November, December quarter also saw a good bit of bounce in the January, February, March quarter. We have seen inflation cooling down. We have seen rate cuts, which helps the industry, which even helps consumption. I think budget also announced a little bit of measures for consumption and financialization. I think a couple of sectors, as I said, one capex-related theme. The second, as I always talk, is more of discretionary consumption related to hotels, related to sort of lifestyle expansion. And the third is financials. And financials, definitely, I don't mean only banks. It is a lot of NBFCs, a lot of companies related to the broking or depositories, exchanges. I think there have been a dream run in some of this, but I don't think if somebody has a 2-3 horizon, why these companies would not do well.
You spoke about financialization trend, which is still very much intact, and exchanges, depositories, etc. What about wealth management? We just saw this big deal where partnership between 360 ONE WAM and UBS sort of setting a valuation benchmark now for the wealth industry, wealth management industry, and the stocks. Your thoughts on this space? And is it attractive to buy in at these levels?
Extremely interesting space, Rima, to tell you the truth. Of course, as I said, we are in the similar space, and we know how in India the number of millionaires and number of billionaires are rising by the hour and by the day. The most important thing is this. The second important part is that as AUMs keep on rising, there are also alternates which have come to the picture. There is so much that people aspire for, and there is so much goal setting. There is so much of things which people want to sort of grow their wealth at a decent pace, right? So earlier, if you think about wealth management, there was just a couple of products. Now, because of the productization, because of the huge bouquet of products, right from equity to debt to alternates to structures to real estate to even overseas investing, I think it's a very interesting space. I think a bit of consolidation has started to happen, as you rightly talked about, a couple of deals, and most of the numbers that the listed players have shown so far have generally been good. So you're seeing a 20-25% type of growth in certain companies as well on even the revenue and the profitability front, which I think augurs very well. I think the size of the market is enough and more for everyone to expand, and even the market shares will be taken over by certain companies. So my sense, this is one prime financialization candidate, this wealth management or private banking as an industry.
Okay, surely find interest in the wealth management side as well. But Devang, I just want to understand in terms of pharma also, what is your thought coming in on that? You have not mentioned it anywhere, though you mentioned IT metals, more on the export-oriented side. Your view on the pharma?
So ideally, what we have gone ahead and told is that there are two things. One, wherever there is global dependence, wherever there are global linkages, now be it IT, be it metals, we know that what happened to IT companies. I think most of these large cap IT companies are trading somewhere near the 52-week low on unknown reasons, right? So most of these companies are growing their top lines by say 2, 3, 4% type of line. So I think probably they might give you returns in the tune of 8, 10, 12%. Even metals the same. Pharma, I think we are clearly bullish on India-centric companies, on MNC companies like About India. I generally just don't recommend ideas, but this is just one portfolio stock that we hold. Now, this is an MNC company which is more of a health tech. But the company has superb ROIs. The company come up with good set of numbers over the last 3-4 quarters. I think these are the type of niche companies that would like to sort of get into innovators rather than being a normal generic company. And you know that probably today the narratives change by the day, change by the hour. And if US announces something, I think again we see a bit of correction. So my sense that we would be probably more domestic facing. Even in pharma, if there is something domestic centric, we would be interested. But otherwise, generally there are so many domestic consumption, domestic financialization, and domestic capex oriented themes that there is ample choice. You are spoiled for choice to buy great companies.
Okay, Devang, thank you very much for that. Nestle numbers are up for you on your screen, and it's bang in line with street expectations. 885 crore is what the company has reported in terms of a bottom line, a slight moderation of 4% year on year, and the top line too at about 5,500 crore has come in line with street expectations. The stock currently is up close to about 1.8%. So after HUL disappointed the street in terms of its EBITDA margin guidance by lowering it, saying they'll unblinkingly focus on growth when it comes to growth versus margin trade-off, Nestle seems to have delivered and met street expectations. We'll await more in terms of the commentary, but revenues at 5,503 crore, in line with expectations, a growth of about 4-5% on the top line. Bottom line has seen a slight bit of a decline of about 5-6% perhaps in the bottom line compared to it on a year-on-year basis. but the stock is holding up okay. We await the margin performance and even the volume growth.
Absolutely. Margin performance and volume growth is something that we're keeping an eye out on. As of now, seems like largely in line with what we were expecting. Nestle is managing to hold on to some bit of a gain as well in today's trading session. 1% uptick as of now, just around that 1% mark. In terms of commentary also, what they've said that, they are seeing beverages, confectionery, which is seeing a good growth coming in for the company. So that is something that is working out well. Margins is something that we'll be keeping an eye out on. But yes, on that note, we're going to slip into a very short break. And okay, actually, we have Prakash Diwan who's joining in with us as well. Prakash, good morning. And Nestle, in terms of numbers, what's your first cut coming in for Nestle? HUL, while it's a bit of a disappointment coming in on that front, Nestle seems to be okay. That's also gone into the red as well. So your first cut on Nestle.
No, so, I don't think there was any high expectation from any of these larger FMCG plays because, demand revival is still some time away. Very clearly, even before the numbers were out, data was very clear, indicating that there could be still some softness because there's no volume growth. Even if they were to improve margins marginally, it's not going to make a big difference till volume growth comes. For both of them for quite some time. Nestle is probably in a better position given the price points that it sells at and the kind of product mix that it has. HUL has certain other things which at times pull it down, especially the high value, high priced personal care stuff, which Nestle doesn't need to worry about. So I think both of them are very similar. They tell you a very common picture. There's nothing, there's no outlier kind of a performance in any of them. So we'll have to kind of just wait for even the commentary to give you that assuage that doubt whether demand is going to grow from here. There's nothing very, very stellar about the numbers at all.
Naveen Kulkarni, Chief Investment Officer at Axis Securities, is also with us on the show. Naveen, in the FMCG staples, Nestle has a bias more towards urban consumption. And we just heard the HUL management where they're saying the macro triggers are positive and therefore urban will now start picking up. Up until now, it was rural driving growth or rural growth outpacing urban. But now urban should start looking up. Would you read that as a positive for a company like Nestle? And two, tell us about the valuation because, generally high valuations, elevated valuations for Nestle has always kept some people on the sidelines when it comes to Nestle.
Yeah, so the pickup in urban consumption going ahead is a positive, no doubt about that. And it should help Nestle probably more than other companies because the brand strength for Nestle is much higher. Their ability to pass on input cost increases, all those things are much, much better than most of the other FMCG companies. So that is certainly a positive. However, the challenges for Nestle are not so much with regards to valuation, but the overall growth trajectory, right? So the valuations, of course, vis-a-vis the growth appear to be a challenge. If growth were to pick up, right, then, of course, Nestle and the likes of HUL and others tend to have very, very high return on equity, right? So from that perspective, they don't need any significant capital to grow. So all those factors will essentially play out, and then, of course, the valuations will get justified. But the critical element will always remain, what is the growth versus the outlook going ahead, right? So those are the critical factors on which I would say that we will have to look at Nestle and Unilever.
Got that. Growth is paramount for all companies and growth has been, in line with expectations, but generally we're still looking at very low to mid-single digit kind of a top line growth. The Nestle share price has dipped down close to about 0.5%. Numbers are in line. We'll await the volume details and the commentary going forward. Get into a break. On the other side, by the way, we thank Prakash and Naveen for joining in. On the other side, Mangesh Bhadang from Centrum Broking will join in on the other side to talk about the latest trends from the cement sector. And Nigel, as you can see, is also waiting by to give us a quick preview.
Welcome back to Trading Hour on CNBC-TV18. And like we promised in our special offering, Quarter Se Quarter Tak, where we bring you key earning expectations from each sector, Nigel today is here to tell us what to expect from the cement sector in Q4 FY25. Nigel, over to you.
Well, in Q4 FY25, cement companies could emerge stronger. Let's quickly run you through what's happening in the industry. First up, cement demand is set to grow by close to around 8%. This after the 6 to around 7% growth that we saw in Q3 and after we had a flattish year in the first half. Demand is now bouncing back across regions. Rural demand is roaring back and the government capex recovery is adding fuel to the fire. On pricing, there's a bounce as well. All regions except South have seen hikes of roughly around 2.5 to 3.5% odd, which has been led by North India, West and Central India. Even April has seen some price hikes, and that's what will give a solid boost to the EBITDA in the coming quarters as well. And after 3 quarters of decline, the EBITDA per ton is set to see some kind of improvement finally. That's thanks to the better pricing that we just spoke about, as well as the operating leverage will play out as well. Though on a year-on-year basis, still that EBITDA per ton will be a little bit lower. Let's focus on company-specific expectations then. Ultratech, well, they gain on volumes from the Kesoram as well as the India Cements integration. Though on the margin, well, that will be capped because they'll be getting the profitability or lack of profitability from both these two acquired assets. JK Cement and Shree Cement, well, they'll benefit from the strong regional pricing, while Ambuja Cement could see a good bounce back after a tough Q3. Before we wrap up, well, let's get you a quick valuation snapshot of the companies. The majors come up for you on the screen, trading between 15 to around 18 times on an EV upon EBITDA basis. That's on the forward earnings, it's FY27. While we also have a few more names, Ramco, Dalmia, as well as JK Cement. So those are the expectations. The big question is, will cement emerge stronger from here on? To answer some of those questions, well, we have with us Mangesh, who joins us. Hi, Mangesh. Appreciate you joining us, this morning. Well, tell us first, what is the read-through you saw from Dalmia's numbers? The positive is that I think prices have moved up a little bit and their operating performance was more or less in line. What's your take? And if we look for any surprise in this quarter, which company could bring that up?
Hi, thanks Nigel for having me. So Dalmia numbers were good, slightly better than what the street expectation was. The EBITDA performance was quite good and they delivered almost 925 rupees of EBITDA per ton. And this is despite lack of pricing as well as volume growth in the southern region where they do have a relatively large exposure. So I read that as a quite decent numbers. And I think, the rest of the players who have, say, lesser exposure to South, I think they would be able to deliver much better performance compared to what Dalmia did. So volume growth, if you exclude the GPA volumes that they had in the previous quarter, I think it is decent. It's not very high, but I think, the industry, they might have only two of the things. Either they will have volume growth or they'll have pricing. And I'm happy that, the industry is focusing on pricing after a long time. So volume growth probably is in line with what the industry had delivered or slightly lower. But I think over the period of, say, 3 to 4 quarters or period of a year, I think their volume growth would either be in line or slightly higher than what the industry has delivered. So good numbers from Dalmia. And I think, the north and east focused companies should be able to deliver much better performance than.
So the outperformance should basically come in from the likes of Shree Cement and JK Cement. Would that be the call you're making?
Yes. So Shree, I think it would be a large outlier this quarter. We are expecting a bumper quarter from Shree, and I think they will be able to surprise on the positive side. So volume growth for Shree was missing for some time. I think they will deliver on it this time around. And profitability, as always, probably it will be an industry-leading profitability. So we are expecting very close to 1,400 rupees of EBITDA per ton for Shree.
Okay, all right. Valuation's not cheap, but this quarter should deliver a strong showing. What about the south-based player like a Ramco Cement? The stock has gone through a period of consolidation. It's come off the recent peak that we have seen. And the past quarter may not be that great because pricing, as we have been discussing, has been weak. Valuations as well, not cheap, but that deleveraging is something that holds them in good stead. What's your call on Ramco?
So South-based companies and specifically Ramco, they had this double whammy that, overall the pricing as well as demand was weak in the regions that they operate in. And a month back, the state government of Tamil Nadu had imposed a royalty on the increased royalty on the limestone that they mine. So that's also going to increase the cost for some of these southern players, specifically located in Tamil Nadu. But I think April onwards, we have started seeing prices move up in the region. And we have seen 30 to 40 rupees on an average per bag kind of price for all these players. And that should actually improve the realizations for Ramco. But in case of Ramco, I think overall the demand environment in South because of the state finances remains weak. And that's why that's something that should actually drive down prices if competition creeps up. They will be able to keep up pricing higher at the moment, but we'll have to wait and see how it pans out going ahead. But for Ramco, I think compared to the valuations, we feel that Dalmia is a much better alternative right now compared to Ramco.
Okay, all right. Mangesh, final question before we let you go. The big boy Ultratech could go through a period of some kind of consolidation on the profitability front as it integrates both the acquired assets, India Cement as well as Kesoram. But give and take everything, give us your top 2 picks from the large cap cement as well as from mid cap.
Yeah, so based on the valuations as well as the regional pricing outlook as well as demand outlook that we have, I think 2 large caps that if I have to pick irrespective of valuation, because I see earnings growth, and as well as strengthening profitability for the sector, are Shri and Ambuja, and within the mid caps we like JK Lakshmi.
Okay, all right, Mangesh, we appreciate you joining in. We look forward to being in touch with you as the result season takes shape for the cement players. But as you said, things are looking a little bit more optimistic for the industry on the whole. So let's see how that goes. Well, that's it from Mangesh and myself. Back to you all.
Well, unfortunately, not looking so optimistic for the FMCG lot. Nestle is now down over 1% and it's moving lower. Volume growth has come in at the lower end of what the analysts were hoping for. I think 2% is the analyst growth. The expectation was 2 to 3%, and Nestle continues to see profit booking. Britannia, too, with that, has taken a tumble, and HUL still down 3.5%, 4%. It's a wrap on Trading Hour with that, but don't go anywhere. On the other side is Halftime Report.